Hey, this is Mark Caliber. It is Friday, October 2nd, and we're going to go through the markets a little bit and talk about, it's already October. We're going to talk a little bit about where we think rates are going to go next year, or at least what different people are saying. So we'll cover that also. So let's go ahead and dive right in to the charts for this week, the past month. So this is today's chart. You'll see that we started out at the very beginning. The line goes up. So remember this, the line represents the bond pricing and prices and rates go in opposite directions. So the initial bump up was caused really basically because the media had put out that the president and the first lady and some others had tested positive for coronavirus. So that kind of rattled the markets. The stock markets, I think the futures were down almost 500 points this morning before the market opened. So that pushes money out of the bond market, out of the stock market into the bond market, causing prices to go up a little bit, which pushes yields down. Now you'll see that over the course of the day, the price did go down a little bit, and that was basically because of some of the reports that came out, but really from everything that I read, that they're not terribly concerned at this point that the president's going to have a very severe version of coronavirus. So a lot of the concern kind of washed away during the course of the day. So again, we are finishing up lower than where we started, so it does push up rates a hair during the course of the day, but not enough. We didn't reprice, and so they stayed pretty consistent during the day. So over the week, you'll see it was pretty choppy, but there still isn't a big range. So we ended up just a hair under where we started. So that pushes rates up just a touch, or it made pricing a little bit worse, but all in all, the rate itself was the same. So over the last month, you can see that the price is definitely lower than it was a month ago. So again, as the price goes down, the rate goes up. So rates have been pushed up a little bit over the last month, and then since March, again, I always go back to March because this is when everything started, when the Fed started pouring money into the market. And so we're just a little hair off, where we were here at the very beginning when the Fed just started dumping all kinds of money in the market. We're a little bit lower than our highs, but again, rates are super, super low. And I don't know that at least through the course of this year that anything's going to change much. The Fed is spending about $100 billion a month buying mortgage-backed securities, just to keep rates consistent, keep the housing market propped up. They don't want the housing market to go to hell in a handbasket because it's the one bright spot in the economy that just keeps chugging along. So let's talk about next year a little bit. There's all kinds of people out there that says rates are going to go to 2%. Rates are going to go to 1.5%. So here's the problem, though. Again, the reason why rates are so low is because the Fed's buying bonds. They're the only buyer. Nobody else wants to buy a financial instrument where their return is based on somebody paying their mortgage every month when there's 10 million people out of work. So if the Fed stops or slows down their purchasing come January, that's going to cause prices to drop because there's nobody else that wants to buy the bonds. So the market's going to push the price down until somebody else steps in and starts buying. Remember, as the price drops, the rate goes up. We have no guidance at all. There's nothing been mentioned that indicates the Fed is going to continue to buy bonds in January. Now, I think that they probably will because I don't think we're going to have a vaccine by then that's actually working. I think that we're still going to have a lot of people out of work. There's still going to be a ton of forbearances. The economy is not going to be up and running, and don't confuse the economy with the stock market. They are not one and the same. So I think that there's a chance that they might keep dumping the money in, but if they don't, or if they slow it down, it's going to push rates up. But I don't see anything that's going to cause rates to go down in any quick fashion because I just, if nothing else, lenders can't handle any more capacity than they already have. And I always come back to the story: if I can only make 1,000 cases of toilet paper a day, and I can sell 10,000 cases of toilet paper a day, why would I drop the price? So, I mean, it's an easy analogy to make. So that's what I think. There's some other reasons behind the scenes. They're trying to get Fannie and Freddie to exit out of the government holding, so that could affect rates. It will affect rates. There's some other things going on, but really it's about the Fed buying. So if the Fed slows down or stops buying in the first quarter of next year, it's going to push rates up. There is no other way. There are no other buyers that are going to come in at that level and save the day. So give me a shout. Rates are still super low. The housing market's still on fire. I know first-time home buyers are having a tough time finding a home and getting their bid accepted. But let me know how I can help you. My pre-approvals are all data-driven, fully documented. We don't put a pre-approval out unless we see everything and we know exactly what we're working with. Have a great weekend, and we'll talk to you next week.